Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. I was reading through the comment section. I wanted to address this and let you guys know my opinion here. Um, so I've been in the markets for like 18 years. I started in my early 20s. I'm 40 years old now. And the one thing that you learn is you got to get your time frames right. Your time frames on the market. If you guys are looking for gains and you're talking about like weeks, your stocks are not the spot to be. Like you shouldn't be in stocks thinking that you can gain money in weeks. You'd be better off just getting another job or doing something somewhere else. I mean, honestly, like it's too short of a time frame. Your time frame should be measured, I think, by the real estate cycle, which is like an 9, 10 year time frame. So 5 to 10 years is kind of what I would look at, and that's where you can get your reliable, I would say, a long enough time where your trade or your investment will work. If you're trying to trade this stuff and it's below like a few months, it the the accuracy and the ability to make money in that time frame is much more difficult. Not very many people are successful in doing it. And usually what happens is they'll make money for a certain period of time and then they have some blowout loss where you lose 50% of your position or something happens and you're back to square one or losing money. So you have to have your time frame right, and you have to look at these things from, I think, a 5 to 10 year holding period. Now, in that period, if you're riding some of these more volatile companies, you're gonna have to be riding up and down, and some of them you may see 20% down days, 20% up days. It could be all over the place. If you're swinging for the fences on some of these small cap companies. And I'm just kind of reading here. It says, okay, I'm scared again. I was watching Kitco and dude says copper and the diversified miners are going to tank with mines going out of business due to China falling apart. He had a big pie chart with red China taking up half the pie for copper and iron ore. What happens to silver with half production comes as byproducts from these mines. Now, there's two things that price commodities. It's the dollar, the value of the dollar, and supply and demand. Those are the two things. What's going on here is we're having some supply problems potential over in China with some of these materials. The other portion is the inflation aspect, and we've got massive inflation coming. So we've got these two opposing forces right now. We've got supply demand in China versus the dollar, which I think will get absolutely slaughtered. And we're seeing inflation out throughout the entire world. It's not just the dollar, but commodities are priced in dollars. So that's why it's important to understand that during an expansionary phase of real estate, historically, the dollar has weakened against other currencies. We've got this weird soup that they created. They're stirring it all up and just keep dumping money into it on top of an expansion phase that's coming in real estate. So it's probably going to be very inflationary. Which force is going to drive iron ore higher and lower? They're bid up against each other right now. I like energy quite a bit because it kind of bypasses all this stuff. And if we have a shortage in energy, the prices will go up. And it's not so much reliant on any one particular sector. It's kind of like a diversified sector because it's used everywhere. If we're going to mine more of something else, well, we'll use more diesel or gasoline or electricity or more energy in its overall mix. So there's that time frame that I want you guys to focus on. I'm a 5 to 10 year investor. I'll cycle out after this is done, but we are in an inflationary period. We are going to see interest rates most likely increase. That increase will cause a rotation of money into our sectors. Now, I have money in these diversified mining companies. I have money in a whole bunch of different things. That's why we diversify. If you guys are over leveraged to one thing, I think you got to rethink your strategy, in my opinion. You got to spread out a little bit. Here's another one. It says, Andy, Tellurian keeps tanking. Guys, Tellurian just came back. It's been going up. I bought that stock at 93 cents in like a year ago, like maybe a little bit over a year ago. And it's all the way up at like $4 or $5. How is that tanking? Like you gotta Stop focusing on the short term. And if you see something pull back quite a bit, wait for it to stop pulling back. Wait for the candlesticks to contract down. And then when they contract down, it looks like it wants to go back up, cost average in. That's how you keep your position sizes under 5%. Make sure that you've got enough money in it to make a difference, but not too much to expose yourself if that position does very poorly, and that you can get your mindset around this volatility. And you just you have to calibrate yourself. And so here's an important lesson. I can put names in front of you all day. You're going to have to be able to hold through this. If you want to make money, you have to be able to hold through it. It's going to get ugly at some point on some of these companies. They're small. They need to raise money on some of them, and they're going to do some share dilution potential because they're going to have to put in these for Tellurian liquefied natural gas, and it's going to take money. They're going to have to get that money from somewhere. They're either going to borrow it or they're going to have to raise it through some stock. But you gotta hold through this. You gotta believe. You gotta get very well versed in ratios and market conditions. Like, you have to know this inside and out. If you know those inside and out, and then you can tie the technicals to it, you're gonna be riding very well. You'll ride this stuff higher because you have the confidence that you're buying a cheap, undervalued asset. Then you just have to ride it up. Riding it up is difficult. Doing nothing and holding is one of the most difficult things, but that's how you make money. You don't make money by buying and selling. You make money by just sitting there and doing nothing, by staring at your screen, looking at, and if you're going into your account every single second and you see these things going all over the place, maybe you need to go after larger companies that aren't as volatile, potentially, because we're going to have 50% pullbacks in some of these companies. It's going to feel like you're getting hit. I mean, I got hit hard yesterday in my account with oil going down because I've got some pretty good investments in oil in terms of dollar values. So you kind of have to get a little bit, how can I say it? A little bit tough. You're gonna have to go through this stuff. If you're going after the big moves, you got to be tough, because volatility, you're going to have volatility in order to have large gains to the upside. This guy wants me to say, who the man? Bannerman. Bannerman. What I usually say is, banner what? Bannerman. Banner what? Bannerman. There we go. So we've got this. Is this only my subject opinion, or we hear in most of the videos, pull back, pull back, pull back, breakdown, breakdown, breakdown. My patience is really over as I urgently need the money till end of November. Guys, if you need your money, I would not be putting money into uranium if you need it in like 15 days. I would not be investing if you need your money in less than a year. So remember, time frame. Your time frame's got to be right. If you're needing money in like 15 days, it should not be in the stock market. You should have it in your bank account. That's my opinion. Says, hey Andy, was curious if you have any investing books you recommend reading. You know what? I've read some books. I read a lot of articles, but there's nothing that stands out where I'm like, wow, this is really what you need to read. Really, the way that I came up with a lot of this is just like logic. And my logic, that when I go through it and pace through it, is really just, how do you tell if assets are cheap? And then what I did is I just logically came to the conclusion. I knew about the ratios in relationship to precious metals and swapping. And I said, well, why don't you just apply it to everything? And that's exactly what I did, is I applied it to everything. I said, well, gold to oil ratio and all these different commodities to gold to the money supply. It's just ratios. And then when you look at things through a ratio perspective, you have to look at how they interact with each other. So if something's cheap and it's becoming, we'll call it, better valued against all the other assets, it just makes sense, like logically to me. I don't need, here's something, I don't need a book to tell me what is logical. I just do it. I don't know. Maybe it's, I have an engineering background, and I've just been in math and science and all this stuff, and kind of just like you come to conclusions yourself. And I think that's what helps me, because when you rely on the opinions of others, it I'll put it this way: if someone says uranium's a bad investment, I'll say I don't care. I'm still gonna buy it. Why? Because logically, and because of where it is on its ratios, it's cheap. It's below its cost curves for the high cost producers. You kind of step through this. And anyone can tell me, some expert can tell me, there's people on here that are saying that oil is going to $25 a barrel. I think they're absolutely nuts. So why do I think that? Because I form my own opinion. And I think that's what a lot of you guys need to start thinking about is investment strategy, time frame of your investments, and why you're investing in it. Why are you investing in it? And if you can answer all those questions yourself, you're going to be holding on to your investments. And I don't think a lot of these really well-off people, when they do investing, they don't look at a book or they don't read books necessarily and say, this is why I'm going it. They logically think through it. So when you look at something, it's like, okay, we're going to have an energy crisis. I saw the energy crisis kind of before it was happening. You could see it in the ratios. They were all cheap. Uranium was dirt cheap. It was 62 pounds to 1 ounce gold. Oil was over 50 barrels of oil to 1 ounce gold. This was back in 2020. And I looked at it and I said, this is ridiculous. I looked at the charts. I did the technical analysis. We're breaking the downtrend lines. I'm like, I am in. I am in, so in. So I started buying like mad. I put my huge core positions, just boom, right in there. I put it with really not more than 5% in each position. Bought them all out. And then I've been holding on ever since. Then I'm watching the technicals, and commodities are starting to outperform the outperform stocks. I'm starting to see interest rates come on up. Everything that's supposed to happen is happening. And I didn't read any of these from a book necessarily. I have looked at articles, and what I try to do is I say, make logical conclusions like, what do interest rates tell us? And what impacts interest rates? And then I had to put it together myself, because I didn't really find a book or anything that told me how this kind of interacts. So for instance, in my opinion, the money supply, the M2 money supply, increases from real estate, residential real estate, in an expansionary phase. Interest rates follows inflation. Therefore, real estate's the driver. Now, there's no book that told me that. I just figured that out myself. Because if you look at history, if you look at just raw data, if you look at the charts, you can piece it all together, and that's what I pieced together. And it could be debated. Maybe I don't have it all completely correct. But if the relationships are there and they're correct in terms of those relationships, then the reason why doesn't matter, as long as they are reliable. Looking at, says patience is very important. I got into PM and uranium equities almost a decade ago, probably 8 years. Bought all my positions pretty cheap. Not fun to have to wait so long, but totally worth it once things turn around. Allowed me to dollar cost average in. Along the way, it's amazing how much a person can accumulate given enough time. Don't mind waiting another year or 3 or longer before I liquidate. Yeah, guys, we're at the beginning of this bull market. We're right at the beginning. It will climb a wall of worry. People are going to be worried. They're going to be worried about things collapsing and whatnot. My suggestion is you have to find someone who can read the data accurately. If you're relying on someone else, a lot of these people that they push out on YouTube, I'm just going to be honest here. All these people get more views taking a fear narrative. They're gonna pump fear out. Fear. They're going to put like crisis, crash, all these things to get your views. And the fear button in the person is stronger than the greed button. So more people are going to be likely to hit on and click on a link because of fear. So there's going to be a lot of fear that's going to be pushed out on YouTube because they're rewarded for it. I don't try to do that. I try to remain level-headed, and I got to see data. So I don't jump to conclusions in the future if the data doesn't support it or the trend doesn't move in that direction. So somebody might say China's going to crash, all this XYZ. Here's the thing. Do you see it in the 10-year yield? Are people running to bonds worried about that crash? They're not. So I'm not worried about that crash because the overall market, and remember, you have to have the same outlook as the market has. So if the market thinks that inflation is going to be a problem, they're going to sell their bonds and have interest rates rise. We are seeing a rising interest rate. Check. A crash is not coming. At least not yet. Because the debt market doesn't think it's coming. So then you look at your ratios. Is oil going up? Yes, it's going up. Short term, yeah, it's going to bounce all around. But overall, the trend is up. Did we break a large pattern? Yes. We are breaking patterns left and right in all these different commodities. The commodity stock ratio is breaking its pattern. It's in a new uptrend. Guys, it's all intact. It's all intact. The short term, you're going to have noise. You're going to have signals. You're going to have things bounce all around on you. You're going to have 40, 50% pullbacks in some of your companies. If that is not what you want to have, if you can't handle a 40 or 50% pullback, you got to get in different investments that aren't as volatile. If you're swinging for the fences, you're going to have to ride through that volatility. You're going to have to change your outlook and paradigm and how you look at investments differently. You maybe have to allocate less money. I allocate 20% of my net worth to the high risk stuff. And you know what? I swing for it. I don't care. I swing. And there'll be companies that I'm like, it's not volatile enough. It doesn't have enough bang for my buck. I go after the stuff that's going to move. And I limit it by portfolio allocation and betting strategies. That's how I play it. A 100-bagger in one of my companies can make up the difference for losing in 4 or 5 other ones completely. I could have 4 or 5 losses in one, get one 100-bagger, and my portfolio will be completely transformed in a 5 or 10-year period. And I have some of these companies that are looking like they could potentially return 50, 100 times my money. It's the way that you have for an investment strategy, how you basically will place your bets, so to speak. And I do have a clip on all that, on investment strategies and how I set things up. It's not about going into a company that just has low risk because it has no upside, it has no move. It can't move very well if all you can get is 4 times your money or 5 times your money or something. I'm going after the big stuff, the small little guys. And if you have a low risk entry point, you hit the high risk button at that point if it's the lowest risk time, because that's the only time you do it. And I also own a lot of physical precious metals, and I consider that to be the least risky investment of any investment, period. Some people don't even consider it an investment, but if you're doing the swapping of metals based off of ratios, I have strategies that can increase my ounces and my dollar value of it faster than the stock market can. Maybe not under certain conditions. But under most conditions, yes, it does outperform it. So I like doing that investment strategy as well. It says a macro force to consider: a potential big detour in Athabasca with a Native American tribe intending to block uranium mining, as I understand. Well, that could happen. That's a risk. It very well could. That's why you have to diversify out. Very well could. Looking down, really like these cringy jokes in your latest videos. Sometimes I throw some cringy jokes in there, guys. That's fine. It says, very encouraging to hear your explanation that rising 10-year yields is a good sign. Higher rates equals higher precious metal prices, and money rotating from stocks and bonds into precious metals and commodities. And the likelihood of a crash is minimal with rising rates. It's true. Really helpful. This guy's wondering where short-term Elliott wave we're at for uranium. I'd have to look at it. I'm not an expert on Elliott wave, but I try to use it where I can, as Elliott wave, I think, exists in the market. It's just humans interacting with each other over and over, which create patterns, repeatable patterns over and over. I think we are very in the early stages of we're going to have a huge move in uranium come. It's coming soon. I can't tell you the exact timing, but it's going to be big and it's going to be volatile. It's going to go up and down and it's going to rip it. I mean, absolutely kill it over the next probably 3 years, 3, 4, 5 years. It's coming. And you're going to see gains that are massive, but you have to be able to hold through it. If you're buying and selling and going in and out, you're going to be caught out. I got caught out last bull market, guys. I'm not doing that again. There's no way. I am completely dialed in. Like, there's no way I'm going to be caught out of these stocks. So I'm accumulating, I'm holding, and when the valuations get expensive, that's when our sell point comes. Or when we see the housing market in real estate really start to dive down. That means a crash is coming. So really what tells you what a crash is coming is the housing starts to dive and their 10-year yield starts to dive, the actual yield. If that starts diving, those two things, and copper falls out, yeah, something's coming. But we can see that before it comes. It gives you some months heads up. If you guys like this content, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.